All right, what's up, guys? Terry James, your mortgage guy, coming to you. Today, I wanted to talk about something that is pretty common, especially with self-employed borrowers. When you are self-employed, kind of what to look for, what are the qualifications, what exactly is to be expected when you are self-employed on a Schedule C. And so if we can understand that, then you can start to plan. Make sure we do it before you file your taxes. Trying to correct it afterwards, we cannot do that. Because when you are self-employed and we're using documentation to verify your income, self-employed has to be verified by tax returns, and we are strictly going to go off of your Schedule C. So it's really important that if you are currently self-employed, how to plan, if you haven't, going forward, how you should file your taxes to make sure your income is reflected, that you can use the income when you want to qualify. So it's a very common thing when it comes to lending, and with with a lot of people who are self-employed, they make a lot of money. However, what they file on their tax returns ends up being less because you don't want to pay, of course, you're trying to bring down your income for tax purposes. However, the only disadvantage is that it hurts your qualification when you're trying to purchase a home. So, for example, one of the things that happens often is that, you file this and then you write off a bunch of stuff on the tax returns, and then you're like, hey, I made $100,000. Well, that's great, but when you look at your tax returns, what we use to calculate your income as a lender, then you're really not making that if you wrote off certain things. So today I want to kind of go through each line item. So this is very simple. It's a very simple process. We're going to go through each line item to tell you exactly what line items are going to be counted, how you should file, so that when you file your tax returns, you know how that's going to count against you. And the other thing, before we get into that, the other thing to be aware of is that for tax returns, for self-employed people, you have to understand too, is that typically the lender is going to require 2 years of tax returns. Okay, so if you're in the middle of this year, and let's say you want to buy next year, so you're like, hey, I'm going to claim more so that I can qualify. Keep in mind, whatever you claimed on last year's returns is just going to be average. So how your tax return looks the previous year can affect what you can qualify for going forward. So that's why it's really important to know this before. And like I always say, plan, plan, plan. So if you make a plan now, then in a year and a half or 2 years, you know how to file so that your income reflects well and you can qualify going forward. Okay? So the first thing that we want to look at on your Schedule C, the most important line item is going to be your line 31. Okay? So line 31 says exactly, basically we start that out with that income. So whatever is on line 31 is going to be the bulk of your income. So when you sit down with your CPA and you're writing stuff off, you want to let them know, hey, these items, some things we're writing off, your line 31 has got to reflect the income that you want us to calculate. So that's what we are going to use when we calculate your income, is line 31. That's the bulk of your income. There are some other line items, which we're going to go through all of them right now, today, and then you will know from there exactly, if you claim this on there, how that's going to affect your bottom line. So the next one is going to be line item 6. Okay, so from your Schedule C, you see the line item 6, which is other income. And so when you have an item on other income, we will not calculate that unless it is non-reoccurring income, or unless it is reoccurring income. So let's say you got paid, or you claim other income, which was a one-time item, or you sold something one time, or you got paid on one job, whatever it is. If it's just a one-time thing, we are not going to use that income. So if you got paid $100,000 on a job and it was just a one-time thing, we can't use it. So at the end of the day, that item will not be included in your income. Okay. The next one is going to be line 9. And line 9 is going to be, I believe that's your depletion, okay? Or I'm sorry, no. Line 9 is actually your business miles. So if you have a line item on there for line 9 and you have information in there, it is going to be added back to you. So if you've written off certain things for business miles, that will be added back to you. The next one on there is going to be line 12, which should be your depletion. So if you have filed, now listen, I'm not a tax attorney. I will not advise on what to put in these items. I'm simply telling you what's in these items, what's going to be included, if it's going to be added back to your income or deducted. I'm not a CPA. I'm not advising you what to put in there, just going through. So if you have depletion on line item 12, okay, so that's item 12, line item 12. If you have depletion on there, that will be added back to you. Okay, same thing with line 13. If you have talked with your CPA and you file something under there, line 13, we will add that back, which is depreciation. That will be added back to your bottom line or to your income. So if you put down 50 grand, we're going to add that back to your income. Okay, so that can help us. Line 24B is going to be, that's the deductible for meals and entertainment. Depending on your business, if you're out, buying dinners or you're entertaining, whatever you put in line 24B, you've talked to your CPA or you file yourself. If you put something in line 24B, we will deduct that from your income. So what that means is that if you have $10,000 in there, your income is going to be minus $10,000 for that year. Okay, so keep that in mind. The next one is going to be line item 30, which is business home use. Okay, so depending on if if you're using your home for business expenses or whatever the case is, if you have an item in there, if you have an amount in there that you're filing off, that amount will be added back to your income. So now that you know some of these line items, you can start planning, and however you file, once you consult with your CPA or if you file yourself, you know what's going to be added to your income and what's going to be deducted from your income. Okay. The next one is going to be, it's line 9, it's going to be your amortization, casualty, and non-reoccurring expense. Okay. That's going to be on page 2 of your Schedule C, section 5. So if you have anything in there for the amortization, casualty, or non-reoccurring expense, if you have filed something in that item will be added back to your total income. Okay, so it's pretty basic, but I think with self-employed, I think oftentimes what we run into in the loan industry is that self-employed will write off so much in the wrong boxes, in the wrong line items, and we can't use the income. So therefore, yes, you might have made 200,000, you might have made 150,000, but if those items are not in the line items that I went over, we're not going to be able to use it. And sometimes you're writing off stuff that are in some of those items where we have to actually take the income from you and deduct that from your total income. And so, as I mentioned earlier, the other thing with self-employed is really important that you keep in mind. It's going to be 2 years of tax returns. There may be some cases where we can use 1 year, depending on, what job you're coming from. These are going to be a case-by-case decision, but typically for most loan programs, it's 2 years of tax returns for self-employed in order to use it. All right. So make sure, as always, you subscribe, hit like, comment, DM me, message me if you have any questions, or even just put up a comment on this video if you have a question about self-employed income, what can be used, what can't be used, and how we calculate it. All right. Until next time, take care.